The mortgage business is built on trust. Borrowers trust us as mortgage professionals with the biggest financial decision of their life. Like, why wouldn't create alignment where everybody wins collectively together? You just shouldn't have to choose, right? You should be able to get both, right? You should be able to get transparency, consistency, inclusion in capital markets, and consistency of execution. In a fully transparent model, you never have to chase price. You always get the best price, and you always get full transparency, and then you just share in it with your business partner. For those of you who do not know, back in April, we hosted a webinar with the topic of transparency in mortgage economics. And to put it bluntly, the response was pretty overwhelming. And we had about 500 people attend the webinar. The number of thoughtful follow-up questions just really told us something important, which is the topic of economics and transparency and just really understanding deeply how all of the money works in the mortgage industry. It resonated deeply across the industry. And so today we just want to continue that conversation and go even deeper into the subject. But before we dive in, I want to remind everyone why transparency matters. The mortgage business is built on trust. Borrowers trust us as mortgage professionals with the biggest financial decision of their life. Partners, business partners, real estate agents, financial planners, builders, they trust us to deliver competitive terms with consistency, with a high level of customer service, and really a kind of a transformational consumer experience. And without revenue and margin, you can't really create scale and you can't create an incredible mortgage experience. So we need that. Teams, if you have a team, a support staff, mortgage professionals, mortgage advisors, they trust their leaders to grow the business and to provide clarity and direction. And without revenue and without margin, it's really hard to grow a business. But too often, transparency in how the mortgage economics really works has been missing. It's obscured, and it's actually oftentimes working against us. So I think that as we better understand this, as we start to learn what's happening, we realize it creates confusion, it creates friction, it creates inefficiency, and more probably than anything, it's just a lot of missed opportunities in a lot of different areas. So, complete transparency is not a buzzword. I think it's all too often misused in the mortgage industry. A lot of companies throw that word around, but this webinar is to show you what real transparency in economics is supposed to look like. And it is a massive competitive advantage. It means that knowing exactly where your revenue is generated, where costs are absorbed, and where investments in growth and tech and in a lot of other areas, how that all can take place. It helps you understand how decisions kind of impact both customers and teams. It empowers professionals to make smarter choices. We get to uncover hidden inefficiencies. We get to build businesses that are not only more profitable, but are also more resilient. They're more customer centric. So that's what today's about. More than just sharing information, it's really about sparking curiosity. So please, we want you all to ask questions, challenge your assumptions, challenge me. And I genuinely mean that. Like this, typically I'm just teaching on these things. In order to go deeper, we really need people to ask questions and engage. And if you don't understand something, if you disagree, if you just have a question, you want me to get more clear on it, just put it in the chat. You can raise your hand. You can come off mute. We can invite you into the webinar and we can just chat about it. Try not to just be here to listen, try to be here to engage, because I want you to walk away with real answers, with a new lens for how transparency can help you unlock growth in your business. So again, if you're listening, encourage you to speak up, but also jot down questions as they come to mind. If you're not comfortable, feel free to follow up with us afterwards. But again, if something's not clear, just speak up, because if you're wondering about it, chances are somebody else is too. And this is a space for dialogue, not just presentation. We also are aware that sometimes people might want to be anonymous as they ask questions. You might not want to show anyone that you're questioning some of these companies, which I completely understand. So feel free to be anonymous. You should be able to ask questions anonymously. You should be able to make comments anonymously, and just understand that you can do that. So with that, we'll dive in. And I want to start unpacking some of the kind of core challenges that mortgage professionals face when transparency is lacking. Then we'll go through the economics and the opportunities that create. To start, I think as humans, we learn better when we use stories or analogies. So today we're going to imagine that we're on the show Shark Tank. Hopefully you all have seen Shark Tank. Now, imagine that a mortgage professional goes on this show. They pitch the sharks just how great they are, how much business they can do, With the shark support and help, they can do an endless amount of business and help so many people. So then the sharks hear this, and this is their response. Imagine the five sharks up front. They say, "Hey, Mr. Mortgage Professional, that's awesome. We will buy your business with a sign-on bonus, and in return, you'll get zero equity in the company. You won't have any transparency into the margins. You'll just sell whatever we tell you to sell, and you'll get paid whatever we want to pay you. You won't participate in any of the revenue as loans are sold on the secondary market. You'll have to grow your business entirely on your own. You'll be on an island. And if you ever want to leave, we will own your database. You can't solicit your clients, but we will. And you can't really bring your team with you. If you try and solicit them, there's lawsuits. Or let's just say you're a broker, because a lot of you might be thinking that's only true in retail. If you're a broker, here's the response. Great. We'll buy your business for $0. You have to do almost everything on your own. We'll give you 30 or more platforms with different technology and processes, and each of those platforms are going to change their margins on a daily basis. The best platforms, the really good ones, the really good wholesalers, they'll add a lot of margin as rates go down. And all that margin is going to go to us as the company, and none of it goes to you. You don't participate in any of the revenue when loans are sold, and because you're maxed on margin, you don't really have scalability in your business. That sounds insane, but every mortgage professional is taking that offer from the sharks. Mortgage professionals are literally the worst contestants in the history of Shark Tank, but we don't have to be. So here's the ask. Here's what we would want to say to the sharks. Say, sharks, I'm looking for an offer where you make an initial investment in my business by helping me invest in lead generation. I would like to be included as an equity partner in the company. I want 100% transparency in the revenue of the company. I want to set total corporate margin for my business. I want to participate in revenue in a way where, as margins start to expand, that my business benefits disproportionately to the company. I want to participate in up to 75% of capital markets revenue when loans are sold. I don't want any non-solicits in the contract. So at any point, if we're not the best partners, we can just take whatever we bought, whatever we've built, whatever we've created to another platform. And you can imagine if the group of sharks were mortgage companies, what their response would be. But if you're the right mortgage partner, every single one of those sharks should say absolutely yes to that deal. Why? Because that partnership makes the most sense. It's the most aligned for both parties. And I'll show you why. But also, before we dive in, I think it's a perfect time to talk about this because as rates are coming down, margins are starting to expand. This is exactly what we expected to happen in 2020 is starting to play out. So I'm really proud that this transparency is coming to market. And my sincere hope is that everybody realizes that this financial model, this transparency that comes along with it, I hope it becomes the norm in our industry, not just the exception. So I'm going to start by showing you something here. Any questions or anything so far? I'm checking the chat. Nope, we look to be good. Okay. So I'm going to just show you this. And please raise your hand if you have questions. Throw it in the chat. Again, Q&A, whatever you need to do. Let me share this. We showed this in the last webinar. I think it's really important to show again. So when I say transparency in total mortgage economics, what that means as the owner of your business, you're the mortgage professional, this total margin number needs to be set by you. So a lot of times what happens is you might run a quote unquote P&L at a company and you get to set your branch margin, but you don't know what the company margin is because the company margin is branch margin plus corporate margin. That's the company margin. So you as the owner of the cost center, you should set the margin for your loans for the entire organization. So if you set a 325 basis point conventional margin, when that loan funds, 325 basis points is what comes in, assuming you don't take any concessions. Same thing, you go down the stack, FHA 425, VA 400. And again, these are totally up to you as the mortgage professional as to where you want to set these margins. Now, the way that the money flows from there is that it's a participation model. So as the cost center owner, 75% of every basis point, and it could be any number, a company can make up any number. This is just what the number that we've chose that we believe is appropriate. 75% of every dollar would come in. So on a VA loan of 400 basis points, when that loan funds, 300 basis points would go to the branch cost center and 100 basis points would go to the organization. And then that same thing would happen on every loan. And then at the end of the quarter, This is where margin expansion is really important, team. Margin expansion is when there's a lot of business coming in. Mortgage companies start to margin up. They start to add margin. If you listen to almost any mortgage company's earnings calls for the publicly traded ones, they will tell you this is the strategy. As rates come down, margins start to go up because mortgage companies realize that it's kind of a evil genius is that loan officers are less price sensitive in lower rate or declining rate markets, which means that's the opportune time for the mortgage company to start making a little bit more margin. It could be 5 basis points, 10 basis points, 20 basis points, and it's called a daily interest margin adjustment. Mortgage companies change these margins every single day. They change them multiple times throughout the day as markets start to move. And they're just turning the dial on margins, but that's really just making your job harder because you have to now sell a margined up rate. So it's a misalignment between both parties. But what is inevitably happening, and I'll show you this here in a second, is that margins are starting to expand. And we believe that margin expansion should primarily go to the cost center owner, which in this case would be yourself. And so every quarter, we want to help with that. So that means that if you were at 280 to 380, which in this case, this branch is 339 or 340 basis points, we actually owe an extra 5%. So now 80% of margin expansion is going to the cost center owner. And once this gets above 380, then 90% of every basis point above 380 goes to the cost center owner. So again, as margins expand, that money needs to go to you as the business owner because you're the one who needs to procure the business. You're out, you're marketing, you're lead generating, you're growing, you're hiring teammates. And the company still participates. The top company still benefits. They just benefit less than you do. They start making 20%, then they start making 10%. And because the baseline to run a great mortgage business is already created in the first 25%. So it creates an alignment between you as the business owner and the company who you're partnering with. That company now is aligned with you to say, hey, look, the only way for the company to make more money is if you do, right? We're just going to make a little bit more. You're going to make a lot more. So let's help you do that. So now you have the ability as the business owner to create margin expansion. You have the ability to change these margins on a consistent basis as the market is moving, changing, and adjusting. Any questions on this? Again, let's make this as collaborative as possible, but feel free to ask questions on this as we go. Now, the second thing that makes it very transparent that you really need to ask for, again, whether you're a broker or whether you're a banker, it doesn't matter, is capital markets. Because capital markets is where a lot of mortgage revenue is created because it can be manipulated in different ways. So a lot of times what happens is companies will add what's called secondary strips. So they'll just add a little bit of margin increases, wholesale and retail, which means that when that loan is then sold, they actually pick up extra money on the secondary, right? When that loan is bought or sold. And that typically for most companies probably should average anywhere from 25 basis points to 40 basis points. However, if you have low balance loans, $200,000 loans, 150,000, 250, those loans have spec pool pickups, they have CRA pickups. So those can have an extra 100 to 200 basis points just in capital markets execution, just an additional revenue that is created because investors will pay up for those lower balance loans. So if you're in a low balance loan market, you're oftentimes missing out on a ton of additional revenue that companies really keep because that is a great revenue generator for them. So we just use 25 basis points as a conservative number. And again, because we want to be fully transparent, we believe that we have to have our branches share in every dollar of capital markets revenue. And so if the branch is above 280 basis points, that means the company's already making good money because there's an alignment there. And so we don't need 100% of capital markets, but we believe it should go to the business owner, which means that 75% of all capital markets goes to the business owner, in this case, the cost center owner, 25% would go to the company. Now, like when someone says transparent, you have to ask them what level of capital markets participation will I get in this transparent business model? And most people will not offer any of it. But the reason is because if we didn't do this, anybody could add 5 basis points, 10 basis points. They just add secondary strips. They say they're transparent, but if capital markets is now making 35 as basis points because 10 basis points was added, they're just moved from front end visibility to back end. So in a fully transparent model, nobody would do this because all you're doing is making the job harder for the mortgage advisor and still giving away 75% of that revenue. Again, it creates full economic alignment. So if these were the margins, and most companies, we average it all in about 360 basis points. So it's 340 here, it's 20 here, so it's about 360. So this is like an average look at a transparent mortgage branch across the company. And again, that's all different demographics. Some are going to be a little lower, some are going to be higher. And what that really equates to for a $50 million mortgage professional, and keep in mind, this $50 million mortgage professional is creating all their margins themselves. So when I say that we are operating around 360, that is not because as a company, that's the margins we are choosing. That means as a company, we are allowing any one of our branch leaders and cost center owners to set their own margins where they are most appropriate in their specific market. So this 360 is not something that anyone in the organization has chosen. It's just a combination of what all of the branches together have effectively chose for their market. So again, you have a $50 million branch leader. That branch leader has, let's call it a 100 basis point comp plan. And comp plans can be changed they can be changed every 90 days. So comp plans can go up or down. Some people choose this to be 50 basis points. Some people choose it to be 150 basis points. The key to LO compensation is that it needs to be your control as a cost center owner, as a branch leader. And what a lot of people miss is, oh, I want the highest LO comp plan possible, which is really not the best strategy because you really want to try and access your funds in the most tax advantaged way possible. So we can get into that in just a little bit. But let's say this team has a production partner, they have a credit analyst, and they have a loan specialist. So it's a 4-person team. This person's only doing their own, they're not pre-approving their files, they're not managing pipelines. They're literally just doing consultations and business development because their production partner, their credit analyst, and their loan specialist does everything else on the file for them. They have a full expense input list. So every expense is accounted for. And again, I'm not going to dive into all these little details, but if you stay to the end, you'll have the ability to dive in yourself. And then you can see really what that looks like in a transparent economic model, which is that just on $41 million, because it's not a full year calculation, the branch leader on their production would make about 187 basis points or $778,000. 62,000 of that is just capital markets bonuses alone, but all the other revenue and expenses are accounted for. And then with this economic model and with all the investments you can make with transparent economics, we believe that most mortgage professionals will double their production, especially if there's an investment in lead generation, there's an investment in technology, there's an investment in team and scalability. Most great mortgage professionals can double their business in 24 months, which now that $50 million originator goes to a $100 million mortgage professional. And now they can outrun some costs. They'd be at about 205 basis points all in, or making just a little over $2 million on 100 million. But it takes transparency to do that. I will stop. If you have questions, please put them in the chat, raise your hand in the Q&A. And team, if you guys see anything, feel free to jump in and stop me and let me know if we have any questions. So the next thing I'm going to show is what is happening, as I talked about, in margin expansion today. So the first products to have margin expansion in a downward rate environment are going to be government loans. What you'll see here is just a raw price analysis. We send this out every 2 weeks. If you are interested and you just want to be on this distribution, if you just want to see what a real raw price is and you want to see what every wholesaler in the country, if you're competing against brokers or if you are a broker, if you just want to get this information every couple of weeks to track it, you can send me an email, ryan.grant@neohomeloans.com. You can connect with me on social media, send me a message. We'll add you to this distribution. So you can just get this every 2 weeks when it comes out. Because again, we want transparency in the whole industry. The best way to get it is just to make sure this is being sent out. This looks like we have a question here. It says, are there many companies you know of that are open to this much transparency, branch manager participation in secondary market, margin, etc.? There's not, Renz, but that doesn't mean that there shouldn't be. Again, our goal here is to teach this to the mortgage industry. And maybe you really love your company. If that's true, take this information to them. Ask them, say, like, why wouldn't we be more aligned from an economic model? Like, why wouldn't create alignment where everybody wins collectively together? And even in the wholesale, space. Like maybe you just love being a broker and working with wholesalers. Go to the wholesalers and say, hey, look, like a good example of this, and I think this is probably a good segue. So I appreciate the question, is we used to 6 to 12 months ago, we used to be very competitive with Rocket and UWM. They used to be right up there with any correspondent raw price. What's happening now is you can see at 575, and again, this was a week ago or so, we were at par. Essentially, the 5.75 is par, 5.875 pays about 50 basis points. You can see, same thing, the best wholesaler in the country, I don't know who Wall Street Mortgage Bankers is, but they're at par, NMSI is at par at 5.75. So we know we're right there. If the best wholesaler is right on line with our best raw price, we know we're doing well. And this also pays capital markets, whereas the wholesalers don't. So we know there's probably a 25 basis point benefit to correspondent pricing versus wholesale because wholesale is not going to share in the secondary gains. You'll start to see margin expansion because Rocket has a lot of people who consistently use them. Because UWM has a lot of brokers that consistently use them, they're realizing, okay, it's time to margin up now. So Rocket is 20 basis points off of raw correspondent price. UWM is 100 basis points off of 110 basis points off of raw correspondent price. But again, they know they have a really captive audience, just like any retail mortgage company does. And so, retail or wholesale, they're going to start to manage margin. They're going to start to maneuver margins around. And what happens in wholesale is people like, well, now they don't have a very good price. So then they have to go to a different investor who doesn't have good technology, who doesn't have quick and efficient fulfillment, who you don't necessarily understand that technology to create efficiency in your business. That's obviously one of the main benefits of retail. But again, people don't like the non transparency of retail, even though it is a superior efficiency model. You just shouldn't have to choose. You should be able to get both. You should be able to get transparency, consistency, inclusion in capital markets, and consistency of execution. You can see in high balance, again, 6%, little above par. Again, correspondent is going to beat. And this isn't just like, when I say correspondent, this just isn't our price. This is just what correspondent investors are giving to retail investors. So it's really any retail investor. You can see Rocket Pro is about, again, 50 basis points off, and UWM is about 150 basis points off. And this is where you start to see major expansion started to happen. 46 basis points above Rocket and 100 basis points in government. Like government spreads should be much closer when it comes to raw correspondent versus wholesale, which you'll see up here with Home Express and Blue Point, but most people don't really know who these companies are. And you're likely not going to want to send business to a company that you don't have experience with, you're not familiar with, because you have a client on the other end of that purchase. You have real estate agents who are depending on you, and you want to know that you'll get consistency of execution. So you're not typically going to chase price. You want to use the same companies that you're accustomed to using, but now you have to deal with margin expansion. And all of this margin expansion, the 100 basis points, is just going to the company. It doesn't go to you. And as I showed you in the other model, in the pro forma, all margin expansion up to 90% goes to you as the business owner or the cost center owner.
Hey, Ryan, we
Another,
have a question on, can you quickly explain
yeah,
what raw correspondent price means?
yeah, great question. So raw correspondent price is what you're seeing over here on the left. So 5.125 pays 100.362. That means that is what the investor is going to pay our company if we were to lock and sell them a 5.125% coupon rate or note rate. So we'd make 36.2 basis points. Now, obviously, nobody's going to do a loan for 36.2 basis points. So what we do is we put a margin on top of that. Now, a typical retail company is going to put their margin on top of that 100.362, the corporate margin, and then they're going to give it to the branch and say, okay, now what margin do you want? But the branch won't ever know what the corporate margin is because they don't share that. And so the reason we compare this number to wholesale is because what you're seeing over here on wholesale has zero lender paid compensation. So if the broker sold with STG, if they sold a 5.125%, they'd make 1.6 basis points. So obviously they wouldn't sell that loan. They'd either have to charge the client points to get that 5.125 rate, or they'd have to go way up the rate stack in order to get lender paid compensation. So they'd have to add margin there. So every correspondent bank gets a raw correspondent price from all their different correspondent investors, and every single day they then layer their margins on top of it. But the problem is that it's not transparent what their margins are. And they can say, hey, look, we're fully transparent. We only add 50 basis points here and 75 basis points here. But the problem is there's no way to know if they're adding secondary strips of 5 basis points or 10 basis points, or maybe they add it in the morning and then the market moves and then they increase it or they decrease it. That's just how secondary markets work. That's how they make money. And if capital markets isn't also a part of the equation, it becomes really challenging to really know what the true margins are there. Another question that says, can you explain what lender investor is behind the correspondent pricing is coming from that you're showing? So what we're showing here, what we do is we just show the best priced investor at every note rate. I'd have to expand it, but it could be PennyMac, it could be Truist, it could be what we call mandatory price, which that means that we're selling directly to the window. We're selling directly to Fannie or Freddie. So at every note rate, the best investor shows up. And it technically doesn't matter what investor it is because we just lock the note rate price. And then it's really up to our secondary team when they create the hedge or the insurance against market movements to go execute on secondary. So we don't necessarily care who the investor is because we're just underwriting to AUS anyways. So we just go right off of the DU or LP findings. But the reason we want to show the investors is we want to transparently show here's the best price investor at every note rate. So it's not like we're only showing you one investor, but there could be three other investors that actually have a better price that we're not showing you, because then we would actually show this, and that's how we'd pick up capital markets. And so that's again how companies play these games is maybe they'll show the best price investor, but there's really three or four other investors that they're not pushing through. And then when that loan sells, they pick up the delta on the back end. And again, if we were to do that, we'd make a bunch of money in capital markets, but then we would just give 75% of it to the branch leaders and cost center owners. So we'd really be shooting ourselves in the foot. We'd make everyone's life and job harder, and it wouldn't be an aligned business model. Really great question. As we get down here into VA, you can see 5.125, 21 basis points as at 5.125. You can see that's better than any wholesaler price in the country. So raw correspondent is about 10, 12 basis points better. And then if you look at, again, the kind of major players were 60-ish basis points better than Rocket and call it 80 better than UWM. Again, just raw to raw there. And so I think that the mistake that a lot of people made when they went and they said, I can't stand the lack of transparency and mistrust in retail. I'm going to go be a broker. That worked for a little while because Rocket and UWM were really leaning in. They were showing really great pricing. But as the market has evolved and as rates have started to come down, these are also publicly traded companies. They need to make money. They need to show profitability. So they're increasing margins. And now the brokers are feeling it. They're like, oh man, like I really thought that this was the answer, but you're not getting the transparency as a broker in the wholesale space either. It's just feels better because you have more options as to where to take it. Where you could say, I'll just take it to Blue Point. Okay, that's great. But then maybe your next one has to go to Mega Capital. Maybe your next one has to go to Rocket. Your next one has to go to Union. And all of a sudden, if you've watched any of my webinars in the past, we believe the mortgage professional of the future will help 50 to 100 families a month. How could you possibly run an efficient business helping 50 to 100 families a month if you had multiple different companies and systems and processes and disclosures and logins that you have if you're constantly chasing price? In a fully transparent model, you never have to chase price. You always get the best price and you always get full transparency, and then you just share in it with your business partner, but you do get consistency of execution because it's the same system, same process, same underwriter, same everything all the time. That's where you can really create scalability in a business. Got another question here. Now, can you share how many back-end investors you have access to in your average scenario in your model? Yeah, and this isn't just us. This is any mortgage company is probably going to have 20-ish correspondent investors, and they're all the best. We all have all the same correspondent investors. It's all the major buyers of mortgage-backed securities. It's the major correspondent banks that are buying these things. And they also, like a lot, like PennyMac, they have wholesale and correspondent. Union has new resi. Like all these companies, oftentimes they don't just have wholesale, they also have correspondent channels. And so it's all the same players, and they're really offering the same terms to almost every of their end users, whether it's the wholesaler or the retail mortgage company, assuming they have good pull through and a few other things. But they're typically always going to be the same there. And then you get into jumbo, and obviously in a jumbo space, that's going to come in and out depending upon the day and the scenario. Most wholesalers aren't really going to play in that jumbo space all that well. Looks like Wall Street bankers is leaning in a little bit here on this one. Let me stop share here. And again, I would encourage you all, please ask questions. Looks like we have Lance wants to be added to pricing distribution. Kristen, if you can take that down, that would be awesome. David is asking, what's your perspective on LO max dollar value amount? For example, LO comp at 125, but capped at 7,500 per loan, no matter what the loan amount is. Really great question, David. Super glad you asked that. So I am a huge fan of a LO comp max dollar amount. But, and this is a big but, only if you have fully transparent economics and you participate in the delta. So for example, let's just use easy math. If I had a 100 basis point comp plan and I had a $7,000 comp max, meaning that if I funded an $800,000 loan, I would normally get $8,000, but instead my $1,000 delta goes back to the company. And what you really don't know in a non-transparent model is that $1,000 that you're effectively giving up with your max comp, is it really being reinvested back into the interest rate? And there's really no way to know that. But what we believe is that if you have a transparent economic model, that $1,000 would just go back into the branch cost center because the branch doesn't have a max comp, just the LO. It's really the difference between that extra $1,000 going to your checking account because it's paid out via W-2 versus going into your business account. So that delta of $1,000 in a transparent model goes into a business account that you own. And then you can decide, do you want to use that to offer a better interest rate to the client? Do you want to use it for marketing? Do you want to use it for growth? But you're effectively being a great business owner by saying, I don't want to take most of the money as the originator. I want to take what's I believe is appropriate for my family, but for whatever's left over, I want to invest back into my business. And it might mean that you want to get more competitive with a client one way or another. So I think that max comp is hugely important, but I only think you should be subjected to it if the delta goes to your business account. Hopefully that makes sense. Anyone have a live pricing analysis comparison? Yeah, if anybody has price that they want to price, feel free to do that. If you want to say, hey, here's my scenario, we can price that real time. I think it's just really important that you all understand. And that's a part of what we would do here in the giveaway is that we wouldn't just price out one scenario for you, but we'd price out every scenario you have. We'd build your financial model so you can have a clear understanding of what true transparent pricing means to you as a business owner. So, Deborah, the tax advantage part of what I was saying is that the problem I'm seeing with a lot of mortgage professionals today is that they want like the highest LO comp plan they can get. I want 150 basis points, I want whatever it is. And a lot of companies are willing to pay that, but then what I'm seeing is they don't have any like pre-tax marketing budget or expense budget. So they make 150 basis points. Let's say it's a $500,000 loan. Close a $500,000 loan. 150 basis point comp plan means that you make a $7,500 check. Let's just say that's the only loan you do that month. You get a $7,500 paycheck and taxes come off of that. Payroll, FICA, everything comes out of it. Insurance comes out of it. And then what I'm seeing is they're then paying their bills, their like business bills from that. So maybe they pay for some vendor software, they pay for some marketing, they're taking realtors out to lunches, they're doing events, and they're paying for all that after tax. They're using their net tax dollars to pay for their business expenses. And that is awful. You're effectively being charged twice. So what I tell people to do more often than not is actually take less. Say, hey, look, I'm only going to take 100 basis points. So on the $500,000 deal, I would want $5,000 to go to my paycheck, but I'd want the extra $2,500 to go into my business account because then I can use my business account money any way I want for pre-tax purposes. So that's a really great way to understand like a real business owner has full control over the tax liability that they pay. And really at the end of the year, as a W-2 mortgage professional, you want your W-2 as low as possible and you want your business account to have a lot of money in it. And you want to access those funds in the most appropriate tax advantage compliant ways that you possibly can. Okay, real quick, Patrick has a deal. So 465 purchase, 418 loan amount. Let me do this. Okay, and we are in Texas, so I'm gonna go. Let me pull that back up. 465, 418.5, 500, 465, and I'll share my screen in just 1 second. See. And we'll just do this one because again, part of the giveaway is that you guys can all get help with this. All right, so let me share my screen here. All right, let me just confirm that was accurate in the chat. Oh, I got to change credit score. So 465, 418.5, and 765. All right, so we'll price it, and then every option will come up, and we can just look at a 30-year fixed here. And so again, this really, as a business owner with fully transparent economics, you will be able to pick any of these. If you wanted to get really competitive and you're like, look, I want to offer a 599, then the company would make 134 basis points on that. Now, that wouldn't be a good margin to offer consistently, but let's just say this is an incredibly valuable client. It's a business partner that you know is going to help grow your business. You can get into other clients. For whatever reason, you want to go help this client, you can offer 5.99, you could offer 5.875, but more appropriately would probably be in the market of 6.375, 6.625. Really depends on where your margins are, where your clientele are. Your value proposition plays a lot into this. And then obviously we want to make sure that we're compliant and we're not offering disparate products to disparate clients for different reasons. But I think most people would probably want to run a margin between 6.5 and 6.625 to run a really great profitable business. Some people might be dipping down into 649 or 6.375. But if I pulled the same thing in the wholesale model, you'd see almost the exact same margins at the top, but then you'd see the really good wholesalers, the ones that people use, would be off by 50 to 100 basis points. Most people would be selling, a lot of brokers would be at 6.375. They'd only be making maybe 130 basis points as opposed to 230 basis points from a gross perspective. Again, I will add a link here in just a little bit when we get towards the end where you can take an assessment, and then we'll reach out to you and we'll schedule a time to go through price analysis, and then we'll go through a pro forma analysis. It says great information. I'm the type of person that learns better by reading information rather than watching on a video. Are there any resources you recommend for me to read to learn more about all this? Man, whomever that anonymous attendee is, I don't believe that there is. And if there is information that you can read, I don't know where to find it because it took us almost a decade for us to learn what we know today, because mortgage companies, both wholesale and retail, do not want us to know this. It's really the way that they've made a lot of their capital. And so for the anonymous person who wrote that, if you do want to just spend some time, reach out. I'm happy to help in any way that I can. And then see, from Quishel, I had another meeting, so I'm just jumping on. We'll receive the recording. Yes, the whole thing will be on YouTube. We will send out the full recorded session to everybody here, so you all have it. All right, let's see. Touch price along with 191 lender options. You're spot on, Ryan. You win just slightly on most margins. David, appreciate you going side by side. Yeah, look, I think there's some companies that are treating people fairly in today's market and they're passing through a lot of the wins. I think that most are not, unfortunately. I speak to mortgage professionals every day. And what I typically find is that there's anywhere from 50 to 150 basis points that they're missing out on. And that can change on any given day. It really just depends on who's really dialing up the revenue on the front end and the back end. There's also capital markets that is then on top of that. Met with a guy the other day. He's a $100 million originator, and he's missing 50 basis points on the front end and he's missing 20 basis points on the back end. And that's after all allocations and everything. And he gets pickups and efficiencies in technology and lead generation and other areas. So it's not always just the dollars and cents team. And again, as I said on the last webinar, I will reiterate again, this webinar is not meant for me to tell you as the mortgage professional that you need to make more of the pie. It's not. There are plenty of companies that will take a tiny little sliver of the pie and you can get 99.99% of it. But then you have to ask yourself, knowing that technology is coming for this industry in massive ways that is already here, knowing that an incredible amount of lead generation is going to be necessary to engage consumers well in advance of decision making, knowing that team and scalability is going to be of ultra importance to capture market share. You need margin and revenue to go get all that. And you want your company to have margin and revenue to go build all that in partnership with you. So being cheaper, having lower margins, and paying less to whomever your partner is not the answer to the future of this industry. It's just not, right? The answer is full transparent, massive alignment, complete partnership to where you understand if I'm paying 25% of the overall revenue, where's that 25% going? What is it being used for, right? Am I getting an equivalent amount of services and value for it? And then as margins go up, right, as they expand, is more of that coming to me because the company doesn't need more and more, but I do because I'm the business owner and the operator. I'm the tip of the spear when it comes to going to get more of the business. So again, that's the whole point of this webinar, is to make sure that you understand alignment and transparency are necessarily there. Another question, just out of curiosity, at what level of production does it make sense to join a model like this, units and or volume? Any level. It really doesn't matter. I think in order to actually run a cost center, you want to be helping at least 5 families a month or doing about $2 million a month in production, because there's just a lot of time, energy, effort, and risk from any mortgage company's perspective. And team, what I'll tell you is that in this model, there's no room for error. At a standard mortgage company, the branch can actually be losing money or breaking even while the mortgage company is doing really well. Why? Because the mortgage company has their standard margin and they don't deviate from it. It might be the branch that has to take the concessions. Oh, I have to take a concession on this. I have to make less on this. But every time a loan funds, the company makes the same amount of money. So the company's doing just fine. They actually don't necessarily care if you're not doing great as a branch. In a fully transparent economic model, if the branch is not doing well, the company is not doing well. If the branch is taking concessions and has low margins, the company is taking concessions and has low margins. So this model really only makes sense for you to run a cost center or run a branch if you are at that volume, because it's a risk weighted trade. And I would say, even if you're helping 1 to 2 families a month, you still want to be a part of this model because you want that company to pour into you until you get to that place, until you get to a place where you're helping that many families and doing that level of production on a consistent 6 months to annualized basis. So that's a really great question. And side note, but what I would tell you all is, if you're helping 1 to 2 families a month, you do not need more money. What you need is more value. What you need is more leads. What you need is better partners. What you need is better mentorship and better leadership. You need someone to help you take the learning curve out of your process and get you to helping 5 families as quickly as possible. Once you're helping 5 families a month consistently, $2 million of volume consistently, that is when you can start to really start to focus on dialing in all of the economics and maximizing revenue and investing back into your business. But until then, you just need to help more families. And there's a lot of things that good leaders can do to help you get there. Great question. Okay. Am I understanding that the model you're proposing shifts a lot of loan revenue from the company to the cost leader? If so, how would you recommend approaching the conversation with the company? Great question. Yes. Yes. In a in this model, what I can tell you is this level of aligned, transparent economic model, the company will make a lot more money, the company as a whole. The difference is, where does that money end up? Because when everyone's aligned, you fight for every basis point. And when you fight for every basis point, everybody gets to participate. It's just that, yes, the company itself will make less of the incremental upside of the revenue, but the company doesn't need that revenue to run a really great business. Now, if they're giving you leads, then you just take whatever they give you. But you're the one who's out there working nights and weekends, and you're the one at open houses, and you're the ones finding all this business, which is the hardest part of the business. You're the one that's running your team. You're the one that's working loans through the system. Mortgage companies, at the end of the day, we fund loans, we help, we have leadership. Correspondent or is, you probably get a little bit more, but wholesale literally just, yeah, but yet they control margins. Right? It's inappropriate. And so it's not that the company makes more money, it's that they make an appropriate amount of money while the alignment goes to you as the business owner in partnership with the company. So hopefully that answered the question and makes sense. Billy's got a question. Ryan, have been in correspondent and hedging side of the business for a while. No, capital markets isn't risk free. Yes, great question. I get this a lot. Hey, Ryan, I went to my company and I told them that we should participate in capital markets. And they said, well, capital markets doesn't always make money. You'd have to participate in the loss. I think that is people, again, Billy used the COVID example when pipelines got hit hard, rates collapsed. Those are black swan events. They're pretty rare and they're few and far between. The way that we handle that and the way that we would encourage any mortgage company to handle that is that, yes, mortgage companies can lose money in capital markets or on a trade, a hedge, on a trade. They can even lose money in a month. But we've been doing this for 4.5 years now. There hasn't been a single quarter where we've lost money. We've lost money on trades, we've lost money in a month, but over a 3 month period of time, we've always had a profitable cap market distribution. So what we tell our team is, first of all, there's never been a negative. If there were to be a negative, let's say it's a I'm sorry, let's say it's $1 million negative in Q1. We wouldn't actually charge the branches for that negative. What we would do is we go into Q2, and let's say we have a $2 million positive in cap markets in Q2, then the branches would just get $1 million distribution for the first 2 quarters. So that is how real capital markets should be shared. And let's just say there's a black swan event where, for example, the first quarter of 2020, there was a ton of insecurity in capital markets. Nobody would have to take the negative. But the upside of capital markets in 2020 was hundreds of basis points. So we would just wait until capital markets normalize to distribute. But if I wish we would have had this model in 2020, I wish all of us would have had this model in 2020 and 2021, because the hundreds of extra basis points, there was 600 basis points of margin in conventional loans in 2020. There was 1100 basis points of margin in government loans in 2020 in the retail space. All of that money just went to the companies. And then what did they do with it? They just turned around in 2023 and 2024 when things got hard. And did they give it back to the people who created it? No. They just paid people sign-on bonuses to come and get even more production and then treat them unfair. This is where like transparency would have created a massive level of wealth for mortgage professionals if mortgage professionals were treated like the business owner. Great question on the capital markets. And again, we handle it in a way where the downside, if it is realized, is offset by future upsides. So, team, I know we only have 5 minutes left, and I just want to make sure that we close strong here. The premise that I'm trying to help everybody understand is that most companies play heads I win, tails you lose. It's 2025, and this game is still being played because many mortgage professionals just either don't realize it or they're too comfortable with their current situation they're in today. So, regardless if you're a broker, if you work for a bank, a credit union, an independent mortgage bank, I don't care. Just do not allow yourself to be treated like an employee at the whim of whatever the company wants to pay you. Remember the rate increase in 2018 when companies started cutting comp plans and branch margins? That was tails you lose, right? That happened to me. And then from 2020 and 2021, historically low interest rates, crazy high margins, 1,100 basis points on some government loans. That was heads, the company wins. And as of late, many of us have experienced lower comp, having to take less. This is the cycle of tails you lose as the originator. So what do you think's coming? You guessed it. Heads, they win. As rates come down, mortgage companies, wholesale companies, they will expand and increase their margins. And you probably won't know nor care because you're selling more loans. So you're happy. It's just not appropriate. These companies are okay paying the signing bonus because they know what's coming over the next few years. And they know that we are the worst Shark Tank contestants ever because we just keep falling again. So to help everyone with this, I just want to offer, here's a link. Team, if you can just drop that link in the chat, click on that link. If you're still here, take an economics assessment. Just fill out that or take that assessment. It'll ask you like 5 or 6 questions. It's not hard. It'll take you probably less than 60 seconds. And then we'll reach out to you. And if you would like, if you complete that assessment, we'll spend time and we'll go through a pro forma, an economic model. We'll go through a pricing analysis. And it's just to show you what's possible. And it's just to illuminate what you could do if you were in a transparent model. And then it's fully up to you about what you do with it from there. You can use it for your business however you want. You could take it to your company and say, hey, I think that we should do this. You can take it to the wholesale companies and say, hey, look, I think we should create a more appropriate model where you stabilize your margins. If I'm a customer of yours, do whatever it is you want with it. If you have questions, we're happy to help. But one of the things for context is that there's a team that recently created this model for themselves because they realized over 10 years, they missed out on $8 million in revenue and compensation. $8 million over 10 years. So, yes, this does matter. Be curious. Don't be comfortable. What is happening on what will happen in the months and years ahead? If it's anything like history has taught us, mortgage companies and wholesale companies will create massive wealth while the mortgage professionals will just do the same thing over and over and get paid the same amount over and over. We cannot accept that. It's not appropriate for your business. It's not appropriate for you as a business partner or as an entrepreneur. So let's stop being the worst Shark Tank contestants ever. And let's start to tell the sharks what it is we want. And if they're smart, they will absolutely say yes. Thank you all for being here. I want to be cognizant of everybody's time. If you have any questions, please reach out. You can reach out to us on Instagram, on LinkedIn, email me, ryan.grant@neohomeloans.com. Fill out that link. There's a ton of ways to get in touch, but I hope this was helpful and look forward to seeing you all next month.